units explode. That is how we usually exit recessions, or in this case, a rolling recession. And we think this time will be no different, except it will be more exaggerated than usual. So I'll go through a few points first, and then we'll go through charts. On fiscal policy, well, today I think the House, after an all-nighter, is probably in the last throes of a vote. By the time you get or watch this, we may have a bill. We know there are some holdouts, but there's a lot of arm twisting too, and I have a feeling it will be successful. So we will have the bill. The most important variables to us are tax rates. The fact that tax rates are not going to go up at the end of this year is very important. And I think that's true. That's all the same in both the House and the Senate. And then on the spending side, we know there's been a lot of drama around this package, especially Elon Musk's opposition to it. And I do accelerated to, I think it's roughly 4.5% or thereabouts. Many people are probably thinking, okay, this is the beginning of an accommodation of all of this profligate government spending. Well, if you look at money in the context of history, this is still a very low growth rate. But we're also seeing at the margin signs that that monetary policy is too tight. Now, we've talked about the yield curve a lot, and as measured by the two-year Treasury yield versus the 10-year. And that has moved back into positive territory, meaning the 10-year Treasury yield is higher than the 2-year Treasury yield. But if you look at the shorter end of the curve, the 90-day T-bill rate versus the 2-year yield, you'll see the inversion is in place still. We've got to basically flat on that basis, and now it's reverted. And that does suggest that monetary policy is probably erring on the side 147,000. But surprisingly, about half of that was government, not federal. Federal government employment fell slightly, but state and local increased quite a bit. Taking out government, private payrolls were up only 74,000 month to month. And there's a plug in the employment report each month, and it's called the birth-death ratio. It's the birth of businesses versus the death of businesses and the employment associated with both. And the working assumption this year is that month to month, it has been in the 80 to 100,000 range. So if you take out that plug, employment could have been negative. ADP, the ADP report earlier this week was negative 33,000. It is more over, I would say, a weak report. The bond market may have anticipated a much weaker report because of how ADP set us up earlier in the week. So it's down a bit, but bond yields have been very well behaved in the last month, especially with all of the drama around the deficit. So with that, let's launch into these charts. So the first chart here is the budget deficit. Now, it's very hard to see on a month-to-month basis, but actually in the last few months, the budget deficit has come down slightly as a percent of GDP already. You can see here the green line and X depicts where Treasury Secretary Bessent aims to take the deficit over the next 3.5 years. And if our outlook for growth driven by productivity is right, we think We think he will be successful. So we think that the tide is down. And the controversy out there, and I think what Treasury Secretary Bessent has been trying to guard against, is that we don't end up in another 70s accommodation period, which led to terrible inflation, double-digit inflation. If we're right, this environment is going to look much more like the 90s, where money growth is above the inflation rate, and actually inflation tends towards a decline. And what that will mean is that the velocity of money is slowing down. Now, the velocity of money, I know I've featured it in charts in the past, but it's been in a secular downtrend since a secular decline. The growth rate had been slowing quite a bit, but the actual decline started in the late 90s. With the occasional cyclical bump. Well, we service. And what you see here is the unemployment rate in the dark brown. And in the gray, you can see the labor differential. So labor differential is based on a conference board metric. Jobs easy to get minus jobs hard to get, or maybe it's the other way around. Jobs hard to get minus jobs easy to get. And based on that metric, the unemployment rate is probably going to continue moving up. Now, what happened in this report, it actually ticked down a bit in today's report from 4.2 to 4.1%. One of the reasons is the labor force is shrinking. And probably what's behind that is immigration, the crackdown on illegal immigration and the deportation of some people. So that could be holding the unemployment rate down. The Journal published an article about college graduates having a difficult time getting jobs. And that's what I mean by entry level. If you look at the statistics, what you'll find is the unemployment rate is up. I think the recent low in that metric was 4%, and we're up above 6%, 6.3 or 6.4%, I think. So it is true that college graduates are finding it difficult to get a job, and AI is probably the reason. So the lesson here, anyone who is thinking about changing a job or looking for a job is start focusing on AI. There's a lot you can do yourselves, and follow Frank Downing, who's our director of research on the next generation internet broadly, but on AI specifically, and Joseph Soya, who is a research analyst, a fairly low level relative to what we enjoyed during the late 90s. We think we're going back to that level and well beyond in a secular sense. I think you've heard us say that we could see real GDP accelerate to the 7% range in more of a sustained way than you see in this chart. Because of productivity and all of the new technologies proliferating. And we do think that's going to be a big antidote to the deficit problem out there, that the deficit as a share of GDP, we would not be surprised. It might take a while, 5 to 10 years, but we will move back into a surplus situation, we believe. Much like Reagan got the ball rolling during the 80s, but we needed 10 years to get get back into a surplus situation under Bill Clinton and Newt Gingrich. And then on the next chart, here's an illustration of so again, those worried about the 70s environment, and I think Chairman Powell's one of them. This chart would would suggest not to worry. Here you can see auto sales. We had the spike pre-tariff, and now it's giving way. We're back to 15.3, and we would not be surprised to see this go actually much lower, because unlike during other recessions, we have alternatives like Uber, and even autonomous alternatives. If you don't want to get into a car with a stranger, and apparently many people don't, we have Uber and Lyft, and then we have Waymo, and now for the first month, we have in Austin Tesla's autonomous service, which it is now, I think, within the last week. And I think important, maybe more important than many people understand, because young people have been holding on for dear life, a lot of different cryptocurrencies, and they don't want to sell them. So now they'll be able to use them to qualify for mortgages. And we think that could open up the housing market more than most people think. Well, here is why prices could go down, especially in the new home sector. So this is new one-family houses for sale. And you can see we're reaching for levels that we saw during the global financial crisis, which was a massive housing crisis. The inventory, in other words, for sale, has weighted again, but including emerging markets. Here's what the dollar looks like. It's strong by historical standards. And again, this is more a comment on weakness in other currencies, perhaps, than dollar strength. If you look at the gold price, the dollar has not been strong at all. It's been losing purchasing power. But if you look at it relative to 26 other currencies on a trade-weighted basis, it still looks to be quite strong. Here you can see the ramifications. Commodity prices, again, still pretty flat in the context of the last, 40-ish years, which many people are surprised to see. I will say that's what we want. We don't want to go back to 1%. But if inflation is going to be as low as we expect, even if growth accelerates, we'll see short rates really responding much more to the growth rate, and long rates tuning in more to inflation. And if inflation's going to, below 2%, maybe even 0%, as we expect, then the Treasury bond yield should probably drop into the 3 to 4% range. And then just a couple of more. Always look at the high yield spread. So the difference between the high yield, so more junk-like bond yields, and the 10-year Treasury yield near its...
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.